Call Raymond Hall.
Thank you, Mr. Speaker. This is an important bill. How important it is? The bill is expected to receive the royal assent in the fourth quarter of 2010, and it will come into effect 18 months after that, which means after that date it will be an offense to carry on or hold out that someone carries on insurance business in New Zealand without a license. So the overall purpose of this bill is to encourage the maintenance of a sound and efficient insurance sector that promotes confidence among policyholders and the general public. The bill establishes a licensing regime for insurers and prudential regulations, with compliance largely self-administrated, while supervision is provided by Reserve Bank. The Reserve Bank had earlier released a draft bill for stakeholder consultation. The paper provides an overall overview of the bill. The Reserve Bank was not seeking policy input, but was asking for comment on legal drafting and operational issues. The key features of the bill are: number one, licensing. Every person who carries on insurance business in New Zealand, except the defined Crown and public entities, must hold a license issued by the Reserve Bank. Licenses may be subject to conditions including requiring a specified amount or proportion of insurer's business to relate to New Zealand policy holders. Businesses must meet certain criteria, including having an appropriate incorporation and ownership structure, governance structure and financial strength, and the ability to carry on its business in a prudent manner. Also having a fit and proper policy. For overseas applicants, having home regulation that is at least as satisfactory as the relevant New Zealand law. Number two, solvency standards. The Reserve Bank may approve solvency standards for insurers after consulting with those it considers will be substantially affected. Number three, credit ratings. Licensed insurers will be required to have a current credit rating from an approved rating agency, subject to limited exceptions for small, new or captive insurers. Number four, overseas policy holder preferences. Overseas insurers will be required to disclose the nature and extent of any requirement in their home jurisdiction that relates to the recognition and priorities of creditors' claims in the event of insolvency, and has the effect of giving a material preference to policyholders in the insurer's home jurisdiction or otherwise is materially disadvantageous to New Zealand policy holders. Number five, actuary audit. And number six, financial reporting. Number seven, statutory funds, which means life insurers will be subject to a detailed statutory fund regime. A life insurer must establish at least one statutory fund in respect of its life insurance business, relating solely to its life insurance business or a particular part of that business. Number eight, Reserve Bank Prudential Supervision. The Reserve Bank will be able to require that an insurer and its associated persons provide to the Reserve Bank any information, data or forecasts about any matters relating to the business operation or management, including corporate, financial and prudential matters for business carried on in New Zealand or elsewhere. Number nine, audit or actuary reporting. Number 10, distress management. The Reserve Bank will be able to direct an insurer to prepare a recovery plan where the insurer is failing to maintain a solvency margin as business is not being conducted in a prudent manner or it is failing to comply with requirements. Number 11, liquidation, voluntary administration and statutory management. And number 12, transfers and amalgamations. And number 13, criminal liability. There will be criminal liability for certain breaches with the potential for substantial fines on summary conviction and, in some cases, imprisonment. Mr. Speaker, it is worth noting that according to the New Zealand Captive Insurance Association, that this piece of legislation could create an unregulated captive insurance industry in New Zealand. The legislation would allow foreign companies setting up insurance subsidiaries in New Zealand to go unregulated. A captive insurance company is designed to underwrite the risks of its parent corporation only. The association president said this morning that this bill, drafted by the Reserve Bank of New Zealand, would regulate domestically owned captives but would not provide for the licensing and therefore regulation of foreign-owned captives. As Honourable David Carnival said earlier in his speech, that certainly would raise a certain kind of concerns. At the moment, there are 6 Australian-owned captives set up in New Zealand. The association's view is that foreign-owned captives are forming in New Zealand and want to be regulated. And I quote, "The Reserve Bank is, by default, encouraging an unregulated foreign insurance industry in this country. This will be extremely harmful for New Zealand's international financial services reputation," close quote. Mr. Speaker, this is a sensible bill, and we will be supporting it through to a select committee. It establishes a prudential regulation framework for the insurance industry. In doing so, it gives a number of powers to the Reserve Bank to carry out its new role. Sadly, this bill does not go far enough. It goes nowhere near dealing with one of the key economic issues facing this currently and presently the state of the state of monetary policy. Labour believes that we need to improve our export performance so we all are better off. Exporters need certainty, and at the moment they don't have that with the exchange rate so volatile. Labour wants to lift New Zealand's economic performance so we all benefit in terms of high standards of living and high incomes. To do that, we need to re-examine our monetary policy, which is apparently not working at the moment. Unfortunately, Mr. Keith's government has so far only attacked the Labour's call to look at our monetary policy and defended the status quo. So, Mr. Speaker, overall, this is a sensible bill, and we will be supporting it through to a select committee. Thank you, Mr. Speaker.